How does the ongoing Israel-Hamas conflict create a financial symphony reverberating through global markets? Have you ever wondered how this localized tragedy becomes a complex economic narrative with far-reaching consequences? In recent Israel-Palestine tensions, concerns are rising globally due to the historical context of ongoing violence. The attack by Hamas in October exacerbates worries about both short-term and long-term economic impacts. This conflict extends beyond local tragedy. It resonates as a complex economic symphony affecting global financial corridors. Let's explore how this conflict can impact the global world.
Oil prices have already shot up amid the uncertainty in the Middle East.
Gold prices have seen a sharp increase. Additionally, U.S. treasuries are in demand.
If the tensions continue, we could see Iranian exports or Saudi exports decrease, and lower supply would mean higher prices.
The recent escalation in the Israel-Palestine dispute is heightening concerns about the global economy, which is already facing challenges. Investors worldwide are anxious about the potential impact of this conflict, especially given the historical context of ongoing violence in the region. The attack by Hamas on southern Israel in early October adds another layer to the complex history.
The brutality of Hamas brings to mind the worst rampages of ISIS,
raising worries about both short-term and long-term economic effects. Let's dive into a story that transcends borders and delves into the intricate web of global finances spun by the ongoing Israel-Hamas conflict. So there's this conflict, right? The clash between Israel and Hamas, a tragic tale that has been playing out for decades. But what you might not realize is that it's not just a local tragedy. It's like a symphony echoing through the world's economic corridors. Let's unravel this narrative together. The heart of the symphony, energy markets. You know how important the oil is, right? Now, imagine the Middle East responsible for a whopping third of the world's oil supply. In the immediate aftermath of the conflict's escalation, the energy markets took center stage in the unfolding economic drama. Oil prices, already elevated, bore the brunt of the tensions. The specter of supply disruptions, particularly if the crisis involved Iran or if unrest affected production in Iraq, loomed large. As a third of global oil supply emanates from the Middle East, any instability triggers concerns about interruptions to global oil supply. The risk premium in oil markets, a reflection of the profits speculators expect during times of conflict, heightened. The impact on global financial markets hinged on the involvement of major regional powers. If the conflict remained confined to Israel and Hamas, the effect would likely be limited, primarily affecting countries with direct trade exposure to the region. Energy costs for businesses and households might spike if the oil supply is interrupted, hampering central banks' efforts to control inflation pressures globally. The Russia-Ukraine conflict had already taught the world that higher energy prices could lead to a more challenging monetary policy environment. History served as a guide, offering insights into the potential economic impact under different scenarios. The 2014 Israel-Hamas conflict, lasting 50 days and resulting in 2,200 deaths, had no significant effect on the global economy or financial markets. In contrast, when Israel and Hezbollah clashed in Lebanon in 2006, oil prices surged globally due to fears of a broader conflict in the Middle East. The dance of global risk aversion. As the conflict intensified, a delicate dance of global risk aversion unfolded. Investors, always wary of uncertainty, began reassessing their strategies. Geopolitical tensions widened spreads and put pressure on currencies, especially the dollar. The tightening of global financial conditions can hit economies with external vulnerabilities. The financial markets, surprisingly, remained somewhat calm in the initial stages of the conflict. A modest decline in global stock prices and a small widening of spreads. But what is the looming risk? If the conflict escalates further, we might witness a more pessimistic financial market reaction. Regional outlook, a tale of resilience and fragility. Now let's shift our focus to the regional outlook. As the conflict raged on, the regional economic outlook became a tale of resilience and fragility. Israel, with a robust economy and a net external creditor position exceeding 30% of GDP, found itself affected through multiple channels. Military mobilization impacted labor supply, reduced tourism, and increased security concerns influenced public spending needs, investment, and capital flows. The shekel, initially weakened by concerns related to the Supreme Court controversy, depreciated further. The Bank of Israel took measures to stabilize financial markets, announcing a program to sell up to $30 billion USD in foreign exchange reserves. Despite these economic defenses, the country faced challenges that extended beyond its borders. Lebanon, already mired in a severe financial crisis, witnessed a GDP decline exceeding 50% since 2018. Jordan, with high external debt and reliance on tourism, faced potential challenges to domestic stability. Egypt, heavily dependent on tourism for hard currency receipts, grappled with economic pressures and wide spreads on external debt. In Gaza, where economic conditions were already dire, the conflict exacerbated existing challenges. Emergency aid became an immediate necessity, and the prospects for reconstruction and future economic activity seemed daunting. The fading prospects for regional normalization added another layer of complexity to the economic tapestry of the Middle East. A shifting landscape, deglobalization, and economic repercussions. Now, here's where it gets interesting. Beyond the immediate conflict, the slow creep of deglobalization added another layer of complexity to the economic narrative. The realignment of global alliances, already underway in recent years, was now accelerated by the events in the Middle East. Countries like the US and UK, concerned about relying on potentially hostile regions for economic activities, began relocating sourcing and manufacturing activities. The reactions to the Hamas attack on Israel revealed nuances in international responses, hinting at a broader trend towards geopolitical divisions. A two-state solution to the Israel Palestine conflict, initially laid out by the United Nations in 1947 and reaffirmed in 1974, faced varied reactions. Most Western countries voiced support for Israel's right to defend itself, while countries like China and Russia called for a ceasefire without taking a stance on Hamas. A prolonged conflict, especially with the involvement of major regional powers, could further accelerate this global realignment. The consequences for global economic growth, already under strain, could be dire. Investors, anticipating increased financial volatility, sought refuge in safe haven assets like gold, whose price surged following the latest escalation. Financial markets continue to monitor the conflict for signs of escalation. Anything that pushes oil prices higher reignites fears of inflation, a significant concern for many countries just starting to see a slowdown after years of persistently high consumer prices. This is not just a tale of localized tragedy. It's a complex interplay of economic forces on the global stage. Unseen ripples, stretching far beyond the conflict zone, create a narrative where economic resilience clashes with fragility. Geopolitical shifts add a layer of uncertainty to an already delicate global economic recovery. It's a story that goes beyond borders, reminding us that the threads of our global economy are intricately woven, and every event, no matter how distant, can send ripples through the entire tapestry.